We sued 3 federal agencies trying to get information about why they bailed out a bunch of rich corporations when they weren't supposed to. A hallmark of a banana republic is messing with financial institutions and manipulating the money supply and, printing currency and hyperinflation and things like that. So we've had a little bit of that. I should say a lot of it, with all the crazed government spending in recent years, inflation that's, in my view, out of control and still is. And then we've had the kind of, the blowback on that is obviously run on a bank, right? Runs on a bank. Bank runs, I guess is the way to put it. And that really hasn't happened, but there have been issues with a few banks where they didn't have the wherewithal immediately to deal with pressure from bank regulators, and so as a result they were taken over by the Biden administration. And of course there's no such thing as a free lunch, so when we spend billions of dollars taking over a bank, guess who pays for it? You do. Now, I would argue ultimately you pay for it as a taxpayer, but technically you pay for it as a bank customer because it increases fees. The way they pay for these bailouts typically is by having the fees that the federal government impose on banks either increase or be siphoned in that direction. So you pay for it one way or another. And we've known, and Judicial Watch has exposed, because the last big financial crisis, we exposed it, is that all these bank bailouts are typically just bank takeovers or political operations. They're not designed to help protect the economy. Well, sometimes maybe they think they're doing that, but it's not like they're using a scientific analysis or a rigorous financial analysis. It's make it up as they go along. And so the 2 big banks that were taken over in the Biden administration were Silicon Valley and Signature Bank. And obviously that happened earlier this year. And we had asked some questions of the U.S. Department of Treasury, the Federal Deposit Insurance Corporation, and the Board of Governors of the Federal Reserve we wanted answers to questions about the bank takeovers. We wanted records about the systemic risk exception granted to Silicon Valley Bank. Such records includes minutes, memoranda, or any communications between the agency or employees or representatives of Silicon Valley Bank. We asked the same for Signature Bank. And what do we mean by systemic risk exemption? That allows the government to come in and protect depositors who have more money than is typically protected by the Federal Deposit Insurance Corporation regulations, which I think is $250,000. The outrage in Silicon Valley is they came in and they protected all these other large depositors who had, relatively speaking, outrageous amounts of money sitting in checking and savings accounts that had no insurance protection under the FDIC. And what did the Biden people come in and do? Well, they just came in and essentially kept them all whole and made them all whole at great expense. Same thing happened in Signature. And the indications are it wasn't because there was truly a systemic risk. In fact, as indications are, you're not reading about bank failures all over the United States or bank takeovers all over the United States. I mean, it looked like these were just one-off issues. Silicon Valley Bank, as to remind you, failed on March 10th, 2023, and Signature Bank in New York City failed 2 days later. On March 12th, the Fed, the FDIC, and Treasury departments, with the approval of President Biden, announced that a systemic risk exception was being invoked in both banks. This, they claimed, would fully protect all depositors. And the effect of that was essentially a signal to all banks that no matter the size of the deposit, we would backstop it. So the liability for you, dear taxpayer, is in the trillions thanks to this decision by the Biden administration. The FDIC standard deposit insurance coverage limit is $250,000 per depositor, per FDIC insured bank, per ownership category. The systemic risk exception allows the FDIC to protect uninsured depositors over that amount. Now, the Hill reports that mid-sized banks are lobbying federal officials to guarantee all bank deposits over the next 2 years, and that small community banks have spoken out against paying more to cover the failure of larger banks such as SVB. So, that helps those big banks, right? Because these smaller banks, these community banks, don't have those big depositors, right? And now there's this economic advantage given to other banks potentially by essentially extending this insurance protection to businesses who should have their monies diversified. Only around 10% of deposits in community banks are above the $250,000 limit. So this is a payout to Silicon Valley, which I'll describe later as a politically connected bank, compared to roughly 90% for Silicon Valley banks. So think about that. So you got these little banks, have a bunch of small depositors. They don't get these types of protections. But Silicon Valley, they've got a bunch of companies who have mismanaged their funds by leaving large chunks of cash in this bank, and we have to bail them out. No, thank you. Fortune reported that the FDIC listed large companies that were in no real danger of failure that it bailed out in the wake of the Silicon Valley collapse. $1 billion at Sequoia, the firm famous for backing companies including Apple, Google, and WhatsApp, they had $1 billion there. I mean, I've heard of Sequoia. Why are we backing them up? They're big guys. They know what to do with their money. And if they've got cash sitting like that in a bank, that's their risk. Sometimes you have to let banks fail, right? Especially banks that do the wrong thing. And if people lose money on it, under the current rules, don't invoke new rules or make up new rules or abuse the rules to protect people who should know better. They're gambling, and we're paying their, it's like privatizing the profits and socializing the risks. And the reason Silicon Valley got this special treatment, I would allege, was because Democrats wanted it to have protection. It was a big bank, Silicon Valley Bank in California, and the reporting was Democrats were pushing for a major bailout of the bank. Gavin Newsom reportedly lobbied, and I guess they were a funder. They helped out Newsom's wife somehow. Nancy Pelosi and other Democrats in California were involved in this fight. And Silicon Valley happened to be a major supporter of President Biden, but I guess we're not allowed to mention that, right? And the board had a bunch of Democrats on it as well. Now, Signature Bank is a little bit more interesting because the infamous Barney Frank was on that board. Barney Frank, you may remember, was a former left-wing member of Congress who was a scourge of the banks, or at least he pretended to be. But even Barney Frank, the leftist, said, they came in, they took over the bank. We didn't need to be taken over. But he thought the reason they had targeted Signature Bank up in New York was because they were into crypto. And the statists running the Biden administration don't like crypto, these cryptocurrencies. So essentially they said all your crypto stuff makes you a risky bank and we need to take you over. So that's why we spent all that money on Signature Valley. Now, the costly Biden bank bailouts, as I say in our release, have all the hallmarks of political favoritism and government overreach. And certainly the fact that the responsible Biden officials, their agencies, are hiding documents about this basic issue. Tell us the reason you decided to support multi-billion-dollar companies with precious taxpayer resources and the resources of other bank consumers. And the fact they don't give us this basic information shows they have something to hide. Now, we kind of know what it's going to show. We're going to find out, because we've done investigations like this before, that systemic risk is just whatever they say it is. They just make it up as they go along, because we uncovered this before. I think I may have talked about this before on the update with Vern McKinley. Vern McKinley was a client of Judicial Watch, and we worked with him to investigate the other bailouts in 2008 and 9, and we were the only ones doing it, practically speaking. And we highlighted this in an op-ed, I think almost 10 years ago, in the Wall Street Journal. In one of his recent lectures at George Washington University, Ben Bernanke, who was a former Federal Reserve chairman, made the self-congratulatory assertion that the forceful policy response led by Federal Reserve in 2008 helped avoid a more serious economic downturn, which I'm sure is what the Biden people say now. And we found, in fact, that it wasn't a forced government response. It was a hapless government response. They had no idea what they were doing. Judicial Watch found in documents, this is a fun story. I read in the Wall Street Journal that in 2008, right, during the whole financial crisis, that the banks got their first big transfer of wealth from the government, quote, protect them and to protect the economy. And the Wall Street Journal quoted the bankers saying, well, we weren't giving any choice. And I thought, well, that's interesting. Let's ask questions about how that happened. Was it a takeover or a bailout? And sure enough, long story short, we got documents that showed that this was still under the Bush administration. First of all, the Treasury Department wanted to call in the heads of the 9 top banks. And the chief of staff for Treasury, if I recall correctly, was like, well, we got to get him in over here, and we got to keep the media away. And by the way, who are the top 9 banks in the country? So they don't even know what they're regulating and who they are supposed to be regulating. They bring in the heads of the banks, and they basically tell them, and we have the notes of the meeting, that we're going to infuse money into your bank, effectively take over your bank through this government lending process. And if you don't want to, we're going to require you to do so, because all the regulators are here and they're going to require you to do so. And they were forced to sign permission slips. And we got the permission slips. It was like 3 lines showing I, Jamie Dimon of whatever, Goldman Sachs, right, authorized the government, and I'll get approval of the board later, to give us $25 billion and, sign our rights away. And it was Judicial Watch that exposed that. So whenever time you hear bank bailout, just remember it's usually a bank takeover. So we've got this big lawsuit. I just love Judicial Watch because, we're all supposed to forget about this craziness, right? All this corruption and government abuse and overreach, and they're messing with our whole entire banking system, and we're supposed to just kind of move along, whistle past the graveyard. We're not going to whistle past the graveyard. We're going to ask questions. We've sued 3 federal agencies trying to get information about why they bailed out a bunch of rich corporations when they weren't supposed to. And the fact they don't want to give us the documents shows you we're onto something. Thanks for watching. Don't forget to hit that subscribe button and like our video down below.